Hey everybody, this is Jose. We are about to get started. Let's have a quick sound check before it's time to begin. If you could type a quick hello on the chat box, that would be great. So I know you hear me well and we are ready to begin. Please do that. So we start in 45 seconds. Thank you so much. Hey Mark, how are you, my friend? Okay, 20 plus seconds and we'll get started. It seems that sound is good. Jeff, how are you, Jeff? Very good. Less than 10 seconds and we start. Very good. Perfect. Time to begin, everybody. Welcome to the session, everyone. Today is July 7, 2022. This is Options Trading Live. My name is Jose Blasco. You can see my email address on the screen in case you need to contact me. This is the time for us to begin trading options, looking at the markets, identifying opportunities, talking about how to put the trades together, talking about how to manage the trades, and all of the above. Before we get started, I would like to highlight the financial disclaimer on the upper left side of the screen. Please read it carefully. It is important information. It is fairly short, isn't it? So counting on you to read it completely. Thank you so much. Perfect. Wonderful. And the sequence, the process that we normally run in those sessions, if you're new to the session, so you're watching this recorded, we are looking at the market environment. From there, we move into reviewing trades that we may have, managing them if needed, and from there, looking for new market opportunities. Okay, so this is the plan. And with that said, time to begin. I would like to mention and highlight, let me turn off the slider on the bottom part of the screen. I would like to highlight this page, which is tradewithufos.com/Jose, which is a page where you could find a series of things. But when you scroll all the way to the bottom, that's where you find the questions and answers section, which is a perfect place for you to communicate, interact with us. There are plenty of questions with answers already there waiting for you. So if you're looking for some answer, just type your question here and you may find it already. And if you don't find it, just click on the green button, phrase your question. Ideally, you add screenshots of your chart, your options chain, whatever is it that you have on the screen, so we fully understand what you need. And from there, we'll provide you with answers. And also, this is an open forum, meaning that everyone is allowed to participate, and that way those conversations can get richer and richer as we all, basically team up in finding those questions and those answers. Anyway, so with all of this said, I would say the session is now properly introduced. I would say the majority of probably all of you are already here. How are you, Joanne? Good to see you. And therefore, it's time now to begin with our market analysis. So I'll start with the VIX because it's an easy one. So when looking at the VIX, we've seen the VIX going down. A collection of red UFOs have been forming, and the VIX is now pointing at 25%. So again, obviously, if you look at the screen and you were to say those peaks all the way are the high and those bottoms here are the lowest price ever. So that's 23, 24, and on the top is like 34, 35. So 25, it's a bit on the low side. Now, it doesn't mean that the VIX is that low, because again, if we look at historical data, the VIX, not too long ago, a couple of years ago, we were used to VIX 12, okay? We got the rally, Jose, you were talking about. Oh, got you. Thanks for that, Joan. I misunderstood what you said there, but now I get you. Thank you for that. So we had a volatility dropping, okay, and this has a lot to do with, as Joan just said, those buyers coming into the market, okay. So now let's take a look and let's get to understand a little better how sustainable this is, or how, what are the specific characteristics of this market move that we're having at the moment. So as always, looking at the S&P, we are now looking at auto climate. Okay, and when looking at auto climate, we can see that we are in an up climate. Okay, since a few days it's moving up. Okay, but I guess you all notice that we are not dealing with thick dots like the ones on the left. We are dealing with a thin dot. Okay, thin dot. So certainly we can see signs of strength coming into the market. The last time we got thin dots, it was 2, then it was 1, then it was 1, then it was, this collection of thin dots, which that was quite unusual. Normally you don't see that many thin dots next to each other. And then we got 2 more, and now we got 3. So it's kind of like the number went from a few to 2 and then to 3. And the beauty is that this is now happening where the implied volatility of the calls, which is the blue line, happens to be above the implied volatility of the puts, which is the gray line. And this tells us that buyers are entering the market. Of course, when looking at implied volatilities, you never know exactly at which strike prices those buyers are located at. So it may be a little higher for breakouts, it may be a little lower for buying dips. Whatever that is, buyers are entering the market, which is in line with the climate being of a blue color. Unfortunately, I'm not too happy about it because, not having a thick dot, then being directional based on auto climate is not something that we should be doing. We should be careful because having the climate not confirmed could lead to a rare continuation of such an unconfirmed climate, but typically the non-confirmed climates lead to climate changes. So sooner than not. Okay, so we gotta be careful with that. Having said that, the market today gapped up, is moving very strongly. So again, just adding a little bit of market analysis and experience here. If the market continue moving like that in today's session, let's say the market was going to close at this particular level, probably tomorrow when the market opens, I would say we are extremely likely going to have a thick dot, which is blue color. So if we had a thick dot, blue color thick dot into tomorrow with the implied volatility of the calls above the puts, blue above the gray, so that's a totally different story. And now we would be dealing with a market environment where going long will make a lot of sense as a priority for directional trades. This is also coinciding. This is something that normally I don't comment, but it's been so extreme in recent times, what we've seen on the dollar index, that if you guys have been looking at the dollar index by any chance, or kind of like the opposite of the dollar index, which in this case would be the euro currency pair. So if you look at what happened to these markets, they've been just like falling like crazy to levels which are statistically not sustainable. So in other words, if the euro is falling, which means the dollar has been rising, and that's not sustainable, which means the euro is going to rally, which means the dollar is going to fall. Well, if the dollar falls, the dollar has less purchasing power, and therefore you need more of those dollars to buy those stock shares. And therefore the price of the shares goes up because you need more dollars to buy the same share. So if all of these make sense, and we get a thick dot into tomorrow or the day after, whenever that happens, we don't know. But if we get a thick blue dot into the following trading day or trading days, we may be in a situation where we have a complete change of a market environment, and we are now moving. Remember that time where I was bringing my red background, kind of using a little bit of humor, but at the same time it was a serious conversation that day. And to be honest, not I'm always right as a trader. Of course, there are many times that is not the case. But that day, I was spot on with understanding that something very bearish was going to happen, and we had a pretty significant drop in the market since then. So now we are kind of seeing the opposite. Okay, the only thing that we are now missing is the confirmation here with a blue thick dot. So if this is happening in the following days, we got multiple ingredients and elements that are lining up in a way where potentially we're going to see the market turn and now begin the beginning of a potentially powerful, longer lasting trend to the upside for those investors, okay, or those position traders and long-term swing traders as well. So that's the market environment we have now. Having said that, it's just kind of like Murphy's law. It's like, I think that, when was that? Was it the last week or the week before? We had a similar situation where we were meeting and we got a thin dot during the session, and I was giving you instructions in case the day after is going to be thick. So we are a little bit in the same situation where we don't have a market condition which is inviting too much to be aggressively directional. Okay. Now, that is, of course, if you got nothing at all in your portfolios, because you may be in a situation where you were long a few positions and you just hitting targets, and now you are closing longs, and now you are too much short, and then you need to add longs just because you don't want to be that much short, or vice versa. You need to hedge your portfolio in a way, right? So, well, if that's the case, then that's the case, and you need to apply the methodologies. It's a difficult period to apply methodologies to be aggressively directional, because basically when you look at the groupings, midterm and long term, notice how everything is kind of red. This one is kind of blue, but it's about to become red. This one is blue, okay, which is telecommunications. So if you were to become long, this group is probably the most interesting one. But the good news is that we can see multiple groups that are now gaining strength, and therefore these red colors, notice how utilities today rotated. Okay, there is a sector rotation there with the utilities in the midterm, and again, if we got a change of climate on the S&P the way I just described, and we get to see a few of those sectors rotate, next thing you know, you have so many opportunities where when you are looking at the matrix and you are filtering for stocks that belong to strong sectors, next thing you know, now you have many opportunities to choose from, which would not be the case today. If today you try to find longs from strong sectors, it's going to be tough. Why? Because there are very few sectors that are strong. Most of the sectors are still in the red. Okay, and again, so we are at that very, very interesting moment in time where it may be the beginning of something quite serious to the upside. Okay, so we gotta watch it, because obviously if that's the case, we gotta position ourselves in a powerful manner to take advantage of it. And if it's not the case, it's okay. There will be more occasions, and if it turns down, we'll trade to the downside. This is not a problem. But I'm just saying, because I would anticipate that some of you in these sessions are active traders, but also you may also run in parallel a little bit of a longer term portfolio, or maybe some of you have 401ks or any sort of retirement account. Depending on the country, it's called differently. Singapore could be a CPF account, etc., etc. And again, so I wanted to give you a little bit of an insight of what I could see happening. We just need that confirmation. Joanne, there is a session today? Yes. You don't see us, Joanne? You don't see us? Because we are in the session, Joanne. This is silly for me to write, but let me write something here. You need to click on the play button to make sure that video and sound are working. But we are in the session. Is everybody watching the session properly? Everybody gets video and sound properly? Any issue out there? Anyway, so while you guys are answering that, let me go ahead and take a look at our current positions. Oh, I didn't say what's the plan. Well, the plan for today, what I would like to do is the following. So since the market is not in a climate, it's not in a place where the climate is defined, and the volatility we saw, the VIX, is quite low. So my favorite choice in a case like that, for the type of trading that we do in the sessions, would be to approach it from a double calendar point of view, to put myself into ranges where increases of volatility would benefit such trades, and get some time decay in the mix and things like that, while I'm not betting on direction aggressively yet. Okay, that would be the plan. And later in the session, I will be looking for double calendars and this type of trade. Cool. So positions, what do we have? Well, we have Verizon. Okay, we have Verizon. Yeah, this is very strange. What may be happening to Joan seems to me very strange. So we have Verizon. So what's happening with Verizon? Well, Verizon is a trade that is almost over, really. If you remember, if Verizon gets to 55 or above, we're going to make the maximum profit. Anywhere, somewhere in here is going to be okay. And even if it goes down, it's okay too, because we cannot lose money on this trade. We had, if I remember correctly, minimum guaranteed of $36 on this trade, given the various massages that we did to this trade. Where we converted the trade, you saw there were two conversions, and this is the P&L of the trade where, worst case, again, we're going to make $36, okay? And best case, we're going to make 286. So we'll see in the end, where is it that we end up? It really depends on where the stock is going. So hopefully, if I am right on the analysis of the S&P and we got a nice push up, well, utilities happens to be or used to be a strong industry. We've seen strength, pretty serious strength coming into the stock. So if the S&P pushes and the stock pushes, we could certainly get to 55. But careful here because we only got until July 15. So it needs to happen now, right? So it needs to start happening immediately. If not, it's not going to be the case. Again, not a problem. If it's not the case, we'll make 36. That's the worst case. So, not too much to discuss here. Delta Airlines, I'm going to come back to this in a moment because we have some work to do and some comments, because also expiration is on the 15th, which is the next Friday. I mean, not tomorrow, but the one after. And therefore, we need to talk about strikes and things like that. So I'll come back to this in a moment. And then we got Twitter, which is a trade I placed last week, but I did not get filled. So if some of you try to get the trade, I would assume that you didn't get filled either. If you did, at the prices I simulated, well, now you will be up by $4, okay? And the trade is looking good. It was an iron condor, but unfortunately, I cannot show executions or anything because I did not get filled. Wait a moment. I was using the wrong symbol. So this is where we enter the trade on this particular day. And as you can see, based on statistics, we should end up somewhere here or here. So in other words, we are far away from the red line and the purple line. So all is looking good for the iron condor to behave as expected so far. So great. The only thing that is not great is that I did not get filled. So I am not in this trade. I will comment on it because it could be a good educational experience. But yeah, I won't be able to place orders or execute since I did not get filled on the initial original trade. Okay. So Delta Airlines, which is the one where we need to talk a bit here, is basically in the same place where it was last week. It's down here. So again, we talked about the consequence that it went so far down, meaning that the puts are extremely deep in the money, the calls are extremely out of the money. And in that sense, it's very difficult to massage the trade and get more juice out of the trade. It's very difficult. We saw how for 2 weeks in a row, we've been rolling the puts just for a break-even opportunity, expecting or giving the stock time for potentially going back higher, and then the week after doing a massage, which is more efficient. But it never happened. It just stays down there, around the $30 mark, and it never rallied higher than that. So in that sense, we have very limited ways on how to help this trade. Okay, and what's the issue here? Well, issue is a strong word because in the end, this trade is going to end up as a losing trade, which is not an issue, it's part of trading. But in a way, I'm using the term issue because we got to be very careful here. Okay, let me close this. And notice I just opened what we have. So we need to be very careful. Wait a moment. We have more than that. Okay. Let me work on that in just a second. So the issue is that every roll that we have done would imply rolling the 36 put and sell a new one using the next week. Well, guess what? We are long the 36 put that expires in July 15. If we go ahead and we roll the current put that expires tomorrow on July 8, if we roll it to July 15, so now it means that you are long the 36 put that expires on July 15, and you sell the July 15 36 put. So really what you're doing here is that you are closing the put you have, you are just closing it. So you would be canceling out the trade, you're flat, you're out, trade is over. So when we do a double calendar, you probably recall that from prior sessions that we had. I'm just gonna write it very quick. So a double calendar is made of buy a call, sell a call with two different expiration dates, and below buy a put, sell a put using two different expiration dates. So that's fine, and you keep rolling the short call and the short put. You keep rolling them every week to the next week. But when you get to the last week, when the stock, when the options are about to expire, you cannot roll using the same week and the same strike, because then you would be killing the call and the put you own long. You need to go one strike below for the put, and you need to go one strike above for the call. And therefore, what you are technically doing is that you are converting your double calendar into a double diagonal. Okay? That's what you're doing. So you are actually not only playing with the strikes, you're actually changing the strategy. Okay, and I want to chart this. I want to put the risk graph in front of you so you see how it is, because obviously there are multiple implications of doing that. Okay, let me see. I did 2 DIL contracts. I have been exercised 100 shares at 36. Still have one short put. Okay. So this is okay. Actually, I'm not sure about which date you have been exercised. I should say assigned, but it seems that the stock have moved a little bit higher. So you have an opportunity to close your 100 shares for a little bit of a better price and sell a new put. Okay, now you don't want to sell a new put using July 8, which is tomorrow. You want to move the whole thing to July 15, which is when the expiration date will take place. Okay, so how are we going to do that? So let me do this. First, let me bring our current trade here. Yes, I can see I made a mistake there. Last week, I guess I did not copy the trade using July 8. I guess I forgot to do that. And I remember why I forgot, because it was a break-even roll. So I didn't do it because it was a break-even roll. But of course, now when I simulate, because the July 1st does not exist, if I start a risk graph, it shows with no short units. Okay, so I'm going to have to edit this manually to add the two short July 8. July 8, 36 put, 43 call. Okay, and the prices that I got. Okay, the price that I got for the call was 37 cents. So the call is 37 cents. And for the put, I'm just replacing what I should have. For the put, we got 72 cents. Okay, so if this is what we have with July 8, so the risk graph of this trade, I did a mistake here for sure. Oh, yes, I got the 30 strike instead of the 36. Here we go. Okay, so here is our double calendar, which you can see it's totally underwater. And the reason why it's totally underwater is because no matter how many massages we have done, all those prior massages from the prior weeks, they just added break even. We didn't add more juice to this trade. Okay, so we are now basically underwater. Why? Because we are very close to the expiration date, so it's really looking like this trade is going to end up losing. Okay, so now what can we do? The assignment was July 6 at 22. Okay, great. So I'll look into that in a moment. Okay, Mark, so I can give you more precise feedback. Perfect, Joanne. Perfect. Thank you. Thank you so much. Not sure what happened on your end. So anyway, so this trade has a risk of $151. So the most we can lose is $151. So this is what's likely going to happen. But at the same time, we need to move from this trade, right, where we are using July 8, to using July 15. And now, as I said before, instead of 43 for the call, we need to go one strike higher, which is 44. And instead of 36 for the put, we need to go one strike lower, which is 35. Okay. Now, if I do that, I'm going to get different values here for the roll. Okay, I'm going to get different values for the roll. Let's take a look and let's get to understand how will this impact my net result. So if I get here into Delta Airlines, and by the way, notice how the 43 put I was never filled on it. Again, another week where I was not filled. So this one, I guess, is pretty easy. I could just cancel, replace the order. I could just select July 50. I'm going to move it up to 44. And whatever I'm given, I'll take it. But the 43 strike right now is trading at, is that correct? No, this is Twitter. I'm like, no, this is not possible. I'm like this is too good. Yeah. So 43 strike. 43 strike is providing 3 cents. So then I'm going to try to get my 15 cents. Maybe I will get it because earnings will be reported soon. So maybe I got this jump in price to the upside, and next thing you know, I get my 15 cents. That would be great. But it's very unlikely. Okay. But in any case, I'm going to place the order now. So the order is in the system just in case. Okay. So here's my July 15, 44 call, ready to be sold, could till cancel, with a limit price of 15 cents or better. So that's it. I have it. Okay. Now, what about the put side? Well, for the put side, okay, and this is going to be interesting. This is going to be probably something new. So if I right click and do my rolling, which so far is all the same as always when we do the weekly roll, I'm going to move from 8 to 15. This is correct. But I'm going to move from 36 to 35. Now, if I do this, notice what just happened here. This trade will be done as a debit. I will have to pay, okay, I will have to pay 93 cents to do the trade. Why? Because the higher the put, the more the premium, the lower the put, the less the premium. So notice if instead of 35, I do 37, now I'm going to get a credit of $1. Okay, I get a credit of $1. If I do 36, basically I got 0 because it's the same strike, even though it could be a little bit if there was a little bit of extra extrinsic value, but it's not the case. And if I look at the 35, which is below, I get minus 95. Okay, so you probably tell me, look, Jose, if you do this and you do 36.35, you need to pay $95 to do this, which means that your initial risk on the trade, which is $151, will be increased by $95, and therefore your total risk for the trade will be close to 250. And you probably tell me, Jose, don't do it. Don't do it. Okay. Is anyone with me, or just for fun? Am I saying something wrong here? Am I missing something by saying that? Which the hint for you is that yes, what I said is not totally correct. What is it that I did not say, which will make this trade to make sense for us to do? Anyone? I take a sip of water. And I want you guys to think of this because, again, there will be times where you may be doing this by yourself at home. And I want to make sure that you guys are building or developing the thinking process to understand what is it that you got in your hands as you're doing those massages, okay? So we understand that every time we do a roll for a credit, it helps the trade. Now I'm suggesting to do a roll for a debit, and you're probably thinking, Jose, what happened to you? You got crazy. We don't do that. We do it for a credit, not for a debit. Why would you do it if it's a debit, right? So I guess you guys are thinking a little bit. So I'll give you the answer. So if you do 36.35, right? Guess what? Okay, let's say the stock on expiration date on July 15, the stock is trading below. It's trading here, below. So what's going to happen? You will be assigned on the 36 and you will be auto exercised on the 35. So in other words, you will be 36 because you are long a put. long a put gives you the right to sell at 36, and you will be assigned at 35, which will make you long stock at 35. So short stock at 36, buy to cover at 35, you're gonna make $1. And in order to make $1, you are paying 95 cents, which is the equivalent of doing a credit of 5 cents. Again, you may think, oh, what a waste of time. But it's been like that for 2 weeks in a row. The fact that the stock went so low means that the puts are so deep in the money that we cannot extract more juice. But we have an opportunity to get $5 more by doing this trade. It's close to a waste of time because it's only $5, but you cannot do more than that. The stock went down a lot, and it's only a $29 stock. It's not a $200 stock. So you cannot get more than that. And the trade makes sense in the sense that you pay a debit, but the debit locks in a benefit of $1. So really, your net profit here would be the $1 minus the debit, which now, if you were to do it at 98 cents, it would be $2 only. Okay. So what I'm going to do is here for the roll, because there is no rush, okay, especially when you are doing sensitive things of this sort, and there is no rush, and you still have tomorrow as well, and all of that. So what I would do, earlier I saw there was 95, so then I would want to go for 95 maximum. Okay, I would want to go for 95 maximum and place that with a limit order, and just let it be. That's what I would like to do. Okay, this is what I would like to do. Let me do one thing here. 1 second. If I do one, if I do 36, 35, it shows as a credit of 95. Good. But now it's the green background. Okay. So now if I do credit, it's a credit of 95. It's a green background, which means that it's going to try to get the lowest price as possible, which is good because it's a negative credit, which is a debit. Okay, so I'm going to use my order like that. Yeah, all is good. So confirm and send, and see if I get filled or I don't. If it filled, of course, later I will tweak it because I want to get these things filled so I can comment on this week after week after week. But this is one of those cases where you have to be very patient, especially because there is no juice to extract. So every cent count. Okay, every cent that you add, it's less, kind of like less pain in exchange for the commissions you have to pay to the trade, right? And so that's what it is. Okay, so if I was to do this, let me graph it. So we're gonna get 5 more cents. So instead of 72, it would be 0.77. And now I got July 35 puts. So if I click OK, so notice how the trade would look like this now, where worst case, you would be losing 146. That's the worst case, which 146 is 146. It's the $151 that we had earlier as a risk, minus the $5 extra I will get if I get filled at 95 cents on the roll. Okay, so worst case now is going to be 196. Okay, now what's the beauty of the trade? Not that it's too beautiful, but it's still very positive, which is that if the stock stays where it is or keeps going lower after the report or gaps up very intensively and goes above 45. So now the worst case scenario from a loss point of view is actually to lose $46. Okay, so this trade, if you do this roll, you're basically locking in the loss of the trade, but you are giving the trade the chance to give you, instead of $146 of loss, to give you $46 of loss only. Okay, and this is why, since a few weeks ago, and please confirm that you now understand what I'm about to say, this is why, since a few weeks ago, where that stock had moved so much against us, and basically the rolls were almost like a waste of time and everything else, so that's why I insisted to stay in the trade and keep going to the end, because now I have an opportunity to take this trade to $46 of loss instead of $151, which is not guaranteed, Worst case, it will be 146, which is still better than 151, but there is a pretty fair chance that we will end up with $46 of loss instead of 151. So it's a great reduction in the pain just by sticking with it until the end and just apply the plan. Now, just imagine, so if this trade, instead of having Delta Airlines go so far against us, Delta Airlines had behaved a little more, well behaved. Oh, look at that. I just got the same problem I had before with my virtual background and my green screen. I'm sorry about that, guys. I will turn off my video camera, okay, because it's very ugly like that. Sorry about that. So, yeah, so again, I guess you get my point, right? That there was a time during this trade where it looked like, Jose, why are you doing this? It's a waste of time. Isn't it better just to close it all together and forget about it? Well, no, because now look at this situation. You took a trade that originally had, let's say, $200 of risk, and now we are wrong, but we only lost 46 if that was to be the case. So it's a great management of the trade by alleviating the problem that the major move on Delta Airline produced, which, by the way, these type of moves are not expected to happen too often because, again, the probability cone suggests otherwise, as well as your UFOs and everything else. It just happens to be that Delta Airlines was, very, very weak. Okay, cool, good price there, Mark, with your 93 on the roll. But make sure that you also close your stock position. Okay, because in your case, okay, I will. Let me go ahead and copy this 1 second. And I will make a comment for you, Mark, based on what you said earlier. So in your case, you had on the put side, you had 2 plus 2. Okay, you bought 2 of the 36 puts. Okay, and then you were short 1 of the 36 put that expires in July 8th, and then you were long 100 shares given to you at 36. Okay, so this is what you had. Okay, so now if you got 93 on the roll, I'm assuming that you took this put, you rolled it, okay, you rolled it for the one which is the 35 put using July 15, okay, but you should do the same with the stock, because long stock is what happens when you have short puts, right? So long stock is the same as a short put that's been assigned. So in other words, you did roll the remaining put, but now for this one, what you need to do is close the stock position and sell another 35 put that expires on July 15. Because that way now you would have not 1, but you would have 2. Okay? So it would be -2 times the puts. 35 put and 35 put, 1 and 1 is 2 against the 2 36 puts you have. Okay, so good job on the roll, but also take care of the stock. Okay, and if that is not clear, Mark, let me know. Happy to explain it again. But yeah, it doesn't do anything for you to stick with the stock. Okay, it doesn't do anything to you. Okay, so what else? Let's look for some trade. Okay, I'm looking at the time. Time goes so fast all the time. It's incredible. So let's go for it. What did I do? Oh, here. Okay, so again, what's the plan? We are looking for non-directional trades. We are looking for double calendars, exactly like Delta Airlines. Okay, the same type of trade. So let's go for it. We're gonna be looking at advanced option scan. We're gonna be looking at low volatility. So I'm gonna start with CIV mean less than 20. We have a few. I'm gonna be looking at our penny increment options list, always picky there. We're gonna be looking at neutrality. So neutral on the daily, neutral on the weekly. We're going to be looking at stocks that report earnings in less than 15 days. That's okay. And yeah, so scan and let's see what we've got. Nothing. Okay. So the problem is less than 20 is not available. So we're going to be looking at technique number 2, which is CIV mean minus historic volatility is below 2 standard deviations. Maybe we got something. We didn't. And option number 3, which normally give us results, is going to be to look at the top decrease in the implied volatility mean in the last 5 days. And when we do that, now we got 2 choices. One is Twitter and one is FedEx. Since we already got a trade on Twitter, I'm going to check FedEx. Okay, and see if we can do this. Let me delete that. Let me delete this. I'm not sure why I cannot. I guess this line is coming from okay. Do some cleaning, guys, if you don't mind. Okay, got it now. Cool. So, what are we having with FedEx? So we're having a market opportunity with earnings happening very far from now. And to be honest, I don't like it because I would like that little e to take place right before the expiration date, so we can use that expiration date and bet on an increase of volatility using that expiration date. But the fact that this B is after the dotted line means that we will need to use the next expiration date, which is all the way in October. Is way too far. We're going to suffer too much time decay before we start enjoying the increase of volatility. Okay, so then I will pass. And to be honest, I'm not super happy to look at Twitter because we already got a thread running. But since I did not get filled, so I think that maybe a valid candidate. And you know what? It is a valid candidate. And you know what? I'm just going to go for it. Okay. So look, I'm going to pretend we are not in a Twitter trade because I did not get filled. And we're going to plan a new trade on this particular stock because the setup seems very adequate to me. I mean, later we'll see if we get an approval or not. But why am I saying the setup looks very adequate? Because of this. Notice how we got the earnings date, and right after we got the earnings, we got the expiration date right after the earnings. So again, this expiration date will inflate, pretty substantially as we're approaching earnings, and therefore we may benefit nicely from the situation I'm talking about. So let's go ahead and take a look. Okay, so we're talking about July 29 for Twitter. So July 29 is right here. So we got that, and then I'm going to look at July 22, 15, and wow, July 15 really have very little implied volatility. What if we add more strikes in the strikes that are further away? Oh, okay, good. We do have a volatility smile, so that's great. That's great because using the green one, which is July 29, we may be able to buy options, further out, which are low price compared to the red ones, which are the July 15. So that's pretty okay. Okay, so the options that are close to the money were not too good, but as we go out of the money above and below price, we can see this beautiful volatility smile. So really, to be honest, I'm okay with what I see. And therefore, we're going to be looking at defining this trade more precisely by first looking at the top of the range, then the bottom of the range. Okay. And then with that in mind, we're going to grab a calculator and divide this into thirds. Okay, so this is 4627. This is 3205. We are talking about a range which is $14.22. If I divide it into thirds, it's 4.74. So if I add 4.74 to 3205, which is the bottom, that gives me 36.79. So 36.79 is more or less here. Okay. And if I take the top, which is 46.22 minus 474 is 41.48. So 41.48, it's somewhere here. And therefore, this is my upper third, my middle third, and my bottom third. So with that in mind, what I want to do is, using that upper third, I want to buy a call. Okay, that is using the July 29 expiration date. Okay, and I want to sell a call, and that's going to be done using July 15 at the start. Okay, that's what I'm going to do. And then for the put side, okay, for the put side, we're going to do the same. So we're going to buy a put, okay, using July 29, and we're going to sell a put using July 15. The put and the calls we need to buy need to be as close as possible to the purple lines. And of course, depending on what's available on the option chain, we'll see what's possible. So what do we have on the option chain for Twitter using July 15, 22, and 29? Okay, and we are interested in strikes which are around 41 to 42. And we are interested in strikes which are around 37. So what's available? So on the 37, we got 37, 36 and a half, 37 and a half, 37, 36 and a half, 37 and a half. But with the further expiration date, with the July 29, we only have the round numbers, 36, 37, 38. Okay, so I'm going to get rid of the ones which are 0.5 because they are not useful. And so I got 41 and 42. This is 41, 48 is almost like me, halfway between 41 and 42. It would be the same to me, to be honest. Let's take a look at liquidity and volume and open interest. So the 41 got some trading going on. 220 to something, 330 to 85. So the 41 got better liquidity. This is wilder spreads, okay, than the 41. So, sorry, I'm looking at the put side. This is a mistake, guys. Sorry for that. So the 41, we're talking about 1 to 131, 0 to 095. Yeah, so similar, but we actually have more liquidity on the 42 with more volume and more open interest. So 42 is actually looking better. 42 is looking better. So we're going to use 42. Okay. And for the put side, which is the around 37, let's see what's available around 37. So we got 37. Again, we're going to use 37 because it's round numbers. So yeah, we got good volume, open interest. Okay, it's fine. So we're going to do 37. Okay, Mark, I'm reading you now. So you sold the stock and the 35 put. Okay, got it. You sold the stock and the 36 put. So you mean now instead of two contracts, you have only one? Is that what you mean, Mark? If that's what you mean, then I'm curious to know how many contracts you have on the call side. Is it one or two? Okay, so we have the trade here. Okay, so let's do it. We're going to be using 15, 37, and 42. Good. So we're gonna be buying the 42 and selling the 42 and selling the 37 and buying the 37. So if we do this, we end up with a trade that looks like this. This is an initial cost of 195, so the most we can lose is 195. Okay, this is the trade that we put in place. The ask and everything looks pretty tradable, and yeah, the setup is definitely valid. Okay, definitely valid. So let's go ahead and execute this trade. Hopefully we'll get filled on Twitter this time, not like the last week. And I didn't get filled on the Delta Airlines roll, so I'm just gonna push it, guys. Okay, whatever I get, I get. I got filled at 102. That would add $2 of loss for me. Okay, so that's not what you want to do, but anyway, so I did it so you can see. Okay, so trade Twitter. We are looking at July 15 and July 29. We are looking at the 42 strike on the call side. We're gonna buy. We are looking at the 42 strike on the call side. We're gonna sell. We are looking at the 37 on the put, and then we are looking at the 37 on the put. So let me reconfirm. So the 2 minus minus are July 15, July 15. The 2 plus plus are July 29, July 29. Then we have call put, 42 for the call, 42 for the call, 37 for the put, 37 for the put. And here it shows us 190. I mean, a moment ago we saw 190 something. Anyway, looks good. So I'm just going to confirm and send. And this trade is there waiting to get filled. And we'll see. If not, I will push it because, as always, I want to have it filled. Oh, look at that. I still have the Twitter order there. No, that's the one I just placed. Sorry. Yeah. I thought it was the one from the last week. I'm like, how can that be? Okay. Yeah. So waiting to get filled here with the Twitter order. And we're looking for 190. Again, we're getting close to the end of the session. So I'll just replace it with a market order. Please do not do that. I always mention, I always say, we need to be patient. It just happens that this is a coaching session and we have limited time. I feel at 198. Okay, good. So I'm going to use those prices, okay, to edit my spread. Now we do have a real trade here that is executed, and therefore it's going to be fantastic to work on this trade throughout the next few weeks and see how we do. So the 42 call that we buy is 121. The 42 call that we sell is 29. 37 put that we sell is 47. And the put that we buy is 153. Okay, so this is the trade that we have. So you pay 198, so the most you can lose is 198. Okay, and of course we are now shooting for an increase on implied volatility towards earnings that we do this to the trade. Okay, plus the various roles that we're gonna be doing to help the trade do better. So I'm just gonna copy this. Okay, I'm gonna put it down here. Okay, it's a double calendar spread and is right here ready to be re-examined into the following sessions that we will do next week. So questions, everyone, is there any question? We are getting close to the end of the session, so this is a great time to have questions answered if there is any question. I'm also making a mark on the chart so we know where the trade was entered. How is it going? All good? And of course, I could understand that you guys are busy putting this on your system so you can evaluate and practice the trade. Good, wonderful. Thank you so much. Good. So I'm about to say bye. Before I say bye, I wanted to remind you all that Saturday is the day where we start our crypto course for the first time. So it's quite exciting. I know some of you are going to be in there. Joanne, Mark, etc. So great. Looking forward to seeing you there. For the ones of you that have not signed up for the course yet, just know that maybe 1 or 2 days left before that can be done. So if you have interest or you have any trading friend that may have interest, let them know, because we're gonna close registrations. Again, 1 to 2 days, and I'm thinking Asian times. Okay, so but anyway, 1 to 2 days. That would be already. So keep that in mind, and hopefully I will see you there. And if not, then I will see you next week in the regular sessions as well. And also wanted to apologize as well for the issue we had the other day. Problem with the internet and so on was the cause for Josip to not to be able to run his session, which is obviously unfortunate. And when we found out the problem, it was very late. And if you guys were attending the sessions, probably you already left by the time that it was clear to us that the session would not be able to run. So sorry about that, guys. Sometimes this could happen, and it does happen. So thanks for your patience and for being here today. And you'll have your SIP back next week. Anyway, everybody, I'm done for the session. I don't see any more questions. So as always, Mark, you will rewatch. Yes, good one. Way to do it. Very good. So guys, as always, thank you so much for joining me. This is always a true pleasure, and keep up the good work. See you soon. See you around, and see you on the next one. Bye bye, everybody.